Well, hello there again, everyone. Welcome to another edition of Tip Tuesday. Jeffrey Nance here with you again. Wanted to welcome you guys in as always. And today we are going to be discussing the topic of short term trading. So, there are a number of different ways that you can trade. You can be a day trader, that's the shortest term trader. And a day trader is someone who enters a trade and then exits the trade in the same calendar day. So that is considered a day trade. Then there is the short term trader, and that's kind of what we're going to focus on today. Then you might have like the swing traders, which is more of what we focus on in, say, step one, and to a larger extent in step two. Those are the kinds of things that you would be doing. So you're kind of looking for several days to maybe a couple of weeks where you would be in a trade and then exit that trade based on your technical analysis. And then you would have like a semi buy and holder. This is someone who would basically be in a trade for some period of time. They don't really necessarily have a chart to go off of, but they just bought a stock with a plan to sell it. And then, of course, the longest of all of these would be the long term buy and holder, who really has no plan to sell. They just buy a stock and then hold it. Now, in their mind, they think at some point I will eventually sell this thing, but they don't have an actual plan in mind. So they may hold it for decades, right? I mean, they may pass it on once they die. So several different ways that we can trade, and we're going to be focused not on day trading today, but the short term trading. And we're actually going to look at five kind of pitfalls of short term trading. So before we really get into the negative part of the short term trading, I thought it might be a good idea for us to at least look at the positive side. So why would short term trading be something that would pique your interest? Why would you be inclined to want to learn how to do that and to find the benefits of short term trading? All right. So the first thing that I would point out is that obviously you're not going to be in the trade for very long. I mean, you're going to be in these trades for maybe somewhere to a day to 3 or 4 days. That's kind of the shorter term. Now, you might could extend that to maybe 2 weeks, but even then, we're kind of getting away from some of the shorter term aspects. So most of these are going to be like a day to 4 day type trades that we're looking at today. So so one of the advantages is that you're not going to be in the trade for very long. Number two is that you have the potential when trading shorter term options to do two things. One is you're going to pay less money. At least your initial investment should be less. Now, one of the pitfalls we're going to talk about is how you actually end up kind of getting into trouble and seeing all those dollar signs, just popping around. And then because of all those dollar signs, you end up putting too much money in the trade, and then you can lose a lot of money real fast. So we'll get back to that later. But we have the potential for very high return on investments. On some of these trades, we could have investments of 200, 300% would not be uncommon when we enter the trade to have that kind of potential. So obviously that is something that's going to pique people's interest and say, oh man, I'd love to make, 100% in less than a week on a trade, that kind of thing. So you kind of get the, that vision up there of how much money I can make and how fast and all that stuff. But yes, at least that is a possibility. And then number three, is that you have the ability then to do some trades that you might otherwise just kind of skip. So you have the potential with short term trading to be able to take advantage of smaller moves. So, if a stock is going to move about 50 cents, you might just look at that and say, well, that's not even worth doing. I can't even really make any money off of that. Well, not necessarily the case with a debit spread. In fact, you could see, say, let's just say you paid 25 cents, you have the ability to make 25 cents a share. So $250, that's 10 contracts. You have the potential to make $250 in a week on a 50-cent move. Now, how many times have you guys seen a stock move 50 cents? Right? It's pretty likely that happens very regularly in the course of a regular trading week. So short-term trading allows us to take advantage of some of these smaller moves. So those are some of the advantages of short-term trading. Those are some of the reasons why people would be interested in short-term trading. And the other thing I would say, the benefit of short-term trading is that it allows you to take a smaller amount of money and then potentially grow that smaller amount of money faster. So those are some of the real benefits. Plus, you can learn how to do what I call proportional trading, which is the ability to say, all right, can I make $100 with a small amount of money? Because if I can make $100 with a small amount of money, then in theory, I have the ability to make $1,000, or really, I might even have the ability to make $10,000 doing the same trade, but with more contracts. So that's really some of the keys of why we might be interested in short-term trading. Now I want to talk to you about some of the pitfalls. Number one, okay, timing. Timing. When you only have a short amount of time for your trade to work, then you don't have time to be, and I'm going to put this in air quotes, wrong. Okay, you don't have time to be wrong because the play or the trade can't go down and then flip around and then come back up and take a week later, and your options have already expired. So you also can't be late. So with regards to timing, you have to be on time. So when that stock is getting ready to turn and move back up, you have to be prepared to enter that trade and get in. So you do have to kind of work on your desire to get in closer to actual pivot points. You don't want to be late. So if we're trying to take advantage of smaller moves, or at least the potential for smaller moves, they don't have to be small moves. But if we're going to take advantage of that, we can't let it move up 60% of its channel and then go get in and be like, oh, this was a great buy point. It's never a great buy point in any way that we teach, but particularly when it comes to short-term trading, you definitely don't want to get in late. So you have to really work on your timing to be proficient at short-term trading. Number two, kind of mentioned this earlier, loss percentage. So one of the benefits of short-term trading is that you have the potential to have higher returns on investments. So most of the time, the way that risk return works is that when you have the potential for higher returns, you also are taking on greater risk. Well, not surprisingly, that is still the case here. So if the trade goes the wrong way, we are going to lose a higher percentage of our money much quicker. So if you are, number three, putting in too much money, then you are going to be likely to dig yourself a really big hole. And it is much harder to dig out of a big hole than it is to dig out of a small hole. So even though all of those things I mentioned to start are very, very enticing, there are things that we think, oh man, I'd love to do some of those things. I'd love to take advantage of that. I would like to be able to do those things. We have to realize that if we get caught up in the thought that, oh, I can make a lot of money real quick, and if I'll just invest more money, I can make even more money more quickly. While that is true, the downside is also true. That if I'm putting too much money in these short-term trades and they don't work, then I'm going to be losing a lot of money quickly, and I'm going to be digging myself a hole that's going to be much harder to climb out of once I figure this out and get better at what I'm doing. Number four, you can't miss your patterns. All right, you don't have time for them to recover. Now, it doesn't mean that you can't get in a trade and have it move against you and then flip around and still work. I'm not saying that. Like, you don't have to be right in short-term trading from the moment you get in till the moment you get out. It can move against you, but again, with shorter-term trading, we are somewhat limited in the amount of time that we have until expiration on our options. So we would have to be right sooner rather than later. So it's certainly better for us, particularly in the shorter term trades, for the stock to move our desired direction sooner rather than later. One of the keys to getting movement right sooner rather than later is to make sure that we're aligned with market tone, and then to make sure that we're getting this pattern right. Are we absolutely in a pattern that we recognize? Is it predictable, repeatable, and reliable? And the thing after that, which we always talk about, but it's even more important with short-term trading, is, am I getting a good buy point? Is this really a good buy point? Or am I just trying to go out there and do something because I want to do something? So pattern becomes really important. And then the last thing I would say is just simply figuring out what kind of strategy that you're going to use. Make sure that you're picking the appropriate strategy for the appropriate movement on that stock. So should I be doing a credit spread? Should I be doing a debit spread? Is it worth it to go out there and do a credit spread where I'm going to make 3 pennies? Probably not. Okay. Particularly if you could do a similar trade with a debit spread and maybe have 100 or 200% return on investment. The last thing I would say about that is, in order to do those strategies and to know when to employ them correctly, you have to know the strategies, right? So one of the things that we want you guys to be able to do is to make sure that you are in a position where you have at least the education to take advantage of whether or not I really should be doing a credit spread here, whether I should be doing a debit spread, and then also knowing the difference between whether or not I should be doing a short-term credit spread or whether it might be better to do a slightly longer-term credit spread. But for the most part, debit spreads are going to be shorter-term trades. They ought to be, and that's how you're going to capture the most value out of those. So those are some of the pitfalls we have, but also some of the benefits. So a little pros and cons here today on Tip Tuesday. If you guys have any other questions about any of this, please let us know. You can reach us at tradeway.com. We've got lots of information available, lots of courses, lots of opportunities. So let us know how we can help you along in your trading journey. Thanks for being with us for another Tip Tuesday.